Hey, welcome back. Richard Kosoff with Guaranteed Rate. In this episode, how do you qualify when you don't qualify? That makes no sense. Well, this episode's all about really qualifying for the self-employed. As you know, when qualifying with a bank, you're showing W-2s, bank statements, 2 years tax returns. The banks want to see the net income on the tax returns. They take your monthly nut divided by your income. That ratio needs to be under 45 or 50%, and you have a loan. But what if that's not the case? Too many self-employed individuals have a lot of write-offs. It makes sense. Who wants to pay lots of taxes to the IRS? Not me. So the question is what happens is that self-employed individuals, they have the write-offs for depreciation, meals and entertainment, car expense, movie tickets, anything you can think of that's part of their business or can be part of their business is a write-off. So they bring their gross income down, they have net income, and that's what the banks look at, which is an issue because when you get a $1 million income and you whittle it down to $27,000, you're not qualifying. So there are programs out there that are really more designed for you. And mostly they come from investment houses because the investment houses are a little more flexible than the banks. Okay, here we go. The first one is a bank statement program. These investment houses will look at 12 months of bank statements. They'll look at the cash flow coming into the bank statement. When they see money coming in for, say, $100,000, they know you're making income. So why wouldn't you be able to qualify for a home loan? So they'll look at the bank statements and then they have to figure out an expense ratio. The easiest way to deal with this is to have your CPA write a letter stating that your expenses are whatever, 20%, 30%. So what happens is the investor looks at the 12-month bank statements. They see you have $200,000 of deposits coming in. Your accountant states that you have a 20% expense factor. 20% of $200,000 is $40,000. So they'll say your income is $160,000 a year, and that's the way they do it. The other piece to this is your accountant has to provide a 1-year unaudited profit and loss statement. The profit and loss statement is basically money in, money out expenses, shows your net income for the year. So the investment house is going to want to see a profit and loss statement that supports the bank statements and the money flow coming in to make sure that everything's on the up and up. But again, no tax returns, and they don't have to see all the nitty-gritty little minor write-offs that bring your income down. That's a great way to do it. Second program is really for individuals that are investors. They want to buy an investment property. Again, they don't want to show the tax returns. Well, there's a program called a DSCR program, Debt Service Control Ratio. DSCR, Debt Service Control Ratio. So what that means is if you're buying a rental property and the rent coming in on that property will be equal to or greater than the monthly mortgage payment, the PITI, principal, interest, taxes, insurance, you have a loan. That's a terrific program. Obviously, the more money you put down, the lower your monthly mortgage payment is, which means the lower the rent you need collected to offset that payment. They're going to support that rent either by the appraiser saying what it rents for. Appraisers have, lots of documentation for a neighborhood. They know what things rent for a 3-bedroom, 2-bath house. And if they don't use the appraiser, maybe you can provide a current lease agreement on the property if it's already an investment property and show how much it rents for. But again, if the rent coming in is greater than the mortgage payment going out, you have a loan. Third way to qualify. This really is for retirement individuals. It doesn't have to be for retirees, but this is where I've seen it used most. It's called asset dissipation. What does that mean? Asset dissipation looks at the accumulated savings somebody has in their bank and uses that money to convert it to an income. The reason why it's great for retirees is because a lot of retirees, obviously not working, they get Social Security income, and then they have maybe $1 million or $2 million or whatever it is saved in either IRAs or 401ks. Well, again, the bank or the investor needs to prove that they can make the monthly payment. So they have to have a technique for converting that money into an income stream. So for instance, some banks will use 30 years as their factor. So if you take $1 million in an IRA account, divided by 30 years, that comes out to about $33,000 in income a year. It'll help qualifying, but that won't qualify for a lot, obviously. But more aggressive investment houses will sometimes use, the most aggressive I've seen is 7 years. So if you take $1 million that you saved in a retirement account and you divide it by 7 years, that comes out to an income of $114,000 a year. Boom, now we're talking. $114,000 in a year in income is about $9,500 a month. Plus, if you have Social Security for, say, $4,000 a month, so now you have monthly income of $13,500 a month. That will qualify you for plenty of home loan. So that's our third technique. And last, and this one's a little crazy, technically, investment houses have to prove to the government what's called an ATR, an ability to repay. And all these other programs do that. This last program is a little bit more aggressive. I wouldn't call it a hard money loan, but it's certainly leaning in that direction. It's no income and no ratio. So when you complete an application, you're not putting down the job, you're not putting down any kind of monthly income, and yet they'll still qualify you. They want you to have at least 20%, and this fluctuates. The last time I saw it was 25% down. Right now, this one company in mind is 20% down. But assume you're going to have to put between 20 and 30% down on the property. Again, no income, no assets. No income, no ratios. You do need to show assets. You need to show the bank statements showing that you have the down payment, you have the closing costs, and you have another 6 or 12 months left over in the bank to show that you can continue making payments for at least a 12-month period, let's say. So if your monthly mortgage payment is $5,000 a month, 5/12, $60,000. You need to show you have at least $60,000 left over in the account, and they will make that loan. So there you have it. And the trick here is that you should know that the more aggressive the loan, the higher the interest rate. So for this program of no ratio, no income loan, you can expect, as of today, probably to pay around 10%. A 30-year conforming, fully documented, is in the low sixes. Last I checked, I think it was 6.25%. So obviously, you're paying a premium. You're paying about 4% more to have a no income, no ratio loan. But you do what you got to do. The DSCR program we discussed, that rate is probably right around 8% today, so probably 2 points above a 30-year fixed rate loan, fully documented. And then lastly, that asset dissipation loan, that's actually in some ways fully documented because you're showing the bank statements, you're showing you have the $1 million. They know how they're going to convert the income. That rate will probably be very close to a 30-year fixed rate mortgage, 6.25%, 6.5%, somewhere in the sixes. So there you have it. When you don't qualify, you can't qualify. It's really geared towards self-employed individuals, but there are options out there for you. This is Richard Kosoff with Guaranteed Rate. Please click on the subscribe button below. If you'd like to work with me, you can go to richard.kosoff@rate.com, drop me a line, and let's do something together. Let's get you pre-approved. Thank you very much, and we'll do it again.